Hello and welcome to Talking Technicals. On the show today we find out how to play rising markets and how to identify market tops. Our show expert Dr. C.K. Narayan will take us through many charts to figure out the beat of a galloping market. So Doc, like we've seen specific patterns when we were looking at market bottoms in our earlier show, we will now look at market tops. There are many patterns that can be formed right at the peak of a market. Which ones would you pick?
Well, if you look at the market tops, I think fairly like what we saw at the market bottom, there are many patterns which actually develop. If you take, for example, the chart of Suzlon, which we saw some time ago, that had formed a head and shoulder on the top as the topping formation. If you looked at, let's say, some other stock like Divi's Laboratory, it actually formed a rising wedge. If you looked at, say, something like Satyam Computer, it had what we call as a broadening formation. And if you look at something like, let's say, Aban Offshore, that would have something like a double top. So the point here is that there are so many varied ways that the market can actually top. You have even more set of topping formation, like a stretch formation, like a triple top formation, like a rounding top formation. So it's actually an endless variety of set of patterns.
So there are many to choose from, and I think you can start and making new patterns even as we go along, because there seem to be just so many. You can put a name to anything, any way a price moves, and if you put a name to it, it's a pattern.
I think if you keep at it, maybe you'll also come up with a pattern very soon.
Well, we wait for our viewers to come up with some new ones, but we've seen this for some of the stocks. Let's see how top formations work on the Nifty, because really what's very important for most markets is to know what's the broad trend of the market. So there are, and interestingly enough, there are more patterns and varied patterns that market indices show when they're topping out. Which ones would those be?
Well, very similar to the set of stocks, the Nifty also is, it shows a variant in terms of the set of patterns that it makes at the top. In the 2010 high chart, which you see on your chart now, you will see that there is something like a broadening formation, right? The market actually got into an area where it made something like let's say a reverse triangle. You will actually see something called a rising wedge, which is what you had seen in the 2008 as the market made. So every time the market makes a bull market peak, you will have a different period. Now in the next chart, which I'm about to show you, will be something like a 2006. Where you had, the market putting in very quick-lived kind of head and shoulder pattern. So whether it is the rising wedge or whether it is, let's say, head and shoulder, or whether it is the wedge pattern or the double top, it really varies whether it's a stock or index. It will always be varied. And
can you confuse one for the other? Because the last one you showed, which was a very quick head and shoulders pattern, could have almost been like a wedge as well.
Yes, very much so. See, let's say the beauty lies in the eyes of the beholder, so does the pattern, right? So what is a wedge to one could be a triple top to another, could be a double top to somebody else, could be a head and shoulder to somebody else. So it's very subjective.
Of going through all of these,
but they're all patterns, right? And they all indicate a reversal. So what does it matter? You give it a name, like Shakespeare said, what's in a name?
Oh well.
Right?
Okay, the whiff of a market peaking out is also smelt with the help of technical indicators. We've been telling you that across all of our episodes. And the most important one in this that holds the key for finding out the reversal, especially for market tops, is the momentum change. And that's the one that really tells you that the action is changing and the sentiment has turned around. Let's see that on the charts.
Yeah, if you have to look at a top and try to catch one, there are only two ways to do it. One is that you actually forecast the top, right? That's a little bit of a difficult thing. It also involves more esoteric stuff within technical analysis. But the easier one, and the one which most people can deploy, is the one using the two sets of confirming indicators that we have spoken about already. One is the volume, and one is your momentum indicator, which you see on your chart right now. I have shown you a chart of ACC with a head and shoulder at the top. So you have a pattern at the top, and if you notice see the volume at the head level is actually significantly lower. And as the head is being formed, you also have a divergence pattern on your, let's say, the RSI indicator here. So the tops are made by the set of patterns combined with volumes, combined with oscillators, all of them collectively putting out signals saying that I'm at a top, sell me.
Okay, and I remember we went through this even when we were doing the RSI. as a tool that the divergence is showing as the highs of the RSI keep going lower. So it's lower highs, whereas your market is peaking out and going up. So that's where the divergence came in. So you love looking at that a lot. You know, whether it's market tops, whether it's just a trend reversal in the interim period, that's something that you would swear by.
Yeah, I think, you know, along with the patterns, you need to have something which also confirms that the pattern is valid. That is volumes and oscillators. So you should always look at volumes and oscillators.
Okay.
They are confirming indicators.
All right. Well, there's one important element in a bull market run, and that is the length of time. How long does it take to ride out a wave? Is it 1 week? Is it 1 month? Or it's 1 year? That's the big question. How long does it take to stay at the top?
Well, I don't have a clear-cut answer in that, saying that it is 1 week, 1 month, 1 year, whatever. Tops, if you're looking at it in terms of a pattern, then any of these patterns that we talked about, double tops, wedges, you know, heads and shoulders, etc., they all take a long, they actually take a long while to play out, right? You need to have a few peaks form, lower peaks form, double peaks forms, etc., volume to get in place, everything. But you know, we also have another pattern which is very swift, and that is what I call as an A-type reversal. You know, you have V-bottom reversal, so similarly you have A-top reversal, which is what I'm showing you on the chart here. This is a chart of something called Core Projects. And if you look at this, you have two tops here, which have been followed by sharp declines, and then you see the way it just drove up straight up, and then gave you absolutely no warning whatsoever, and just slammed straight down. It did it not only once, but again the second time. And, you know, there are certain set of stocks, typically, which are not very institutionally owned or very widely distributed, where the holding is rather concentrated. Those are the ones where it will spend very less time, give you no warning off the top. So if you're not out while it is going up, you'll miss the top.
So how do you avoid something like this? Because
you cannot. You just can't avoid it. It's a characteristic of the thing.
It's just in hindsight, 6x6 vision, but otherwise you just have to go through it.
You just know the characteristic of the stock, know the nature of its holding. If it is well distributed, the tops generally are wider.
Okay.
If it is narrowly held, the tops are very sharp.
Right. Okay, it's time for a break, but we leave you with a question here. You know, market tops are always hard to predict. So the question then is, how do you trade them? So try answering this. The best time to take your profits off the table in a bull market is when A, prices are still rising, B, prices have started to fall, or C, reversal indicators signal a direction change. When we come back, we'll tell you the answer.